Welcome back. There's a look at the early trade in North American markets. The S&P TSX Composite Index, 22,625 points, up a third of a percentage point, an all-time record high. The S&P 500 and the NASDAQ Composite also getting very close, if not at, record highs as well. All three of those indices up. Investors continue to digest the latest producer price index numbers south of the border, as well as results from JP Morgan Chase, Wells Fargo, and Citigroup kicking off bank earnings season. Let's bring in Kristina Hooper. She's Chief Global Market Strategist at Invesco for some insight. Kristina, good morning, and thank you so much for joining us. When you were looking forward to this morning's bank results, you said you would be most interested in loan loss provisions. You expected them to rise. They did, but you said you would be most interested in the rationale, the reasoning for those increases. And we've seen really a whopper of an increase at JP Morgan Chase. What do you think now that you've seen the numbers?
Well, I do think that's something of an anomaly, just given that JP Morgan was probably making up for being more modest in expectations the previous quarter. But the reality is that banks in general anticipate the economy is going to continue to soften. Now, that is an important takeaway for me because I believe it adds fuel to the argument that the Fed needs to cut sooner. That's clear. Banks definitely anticipate that things will be getting worse for consumers. And I think that's a very important message.
All three of the banks also pointed to their card portfolios as a sign of credit losses. What is that telling us?
Again, that's part of that arsenal of data that argues the case that the U.S. economy is softening and that there's not much time for the Fed to act before the economy could get significantly worse. We know this can snowball. And so the Fed needs to act more quickly. It's not just about the fact that we've seen a very significant amount of disinflationary progress thus far. Now we're seeing a softening of the economy. We've seen unemployment go from 3.7% in January to 4.1% in the June jobs report. That all makes the case for why the Fed needs to be concerned about, alert to the potential for this economy to soften a lot in coming months.
Okay, you have increased exposure to smaller cap stocks and cyclical stocks on behalf of clients. Why so?
So my argument, this is just our sense of where we're likely to see opportunity in coming months, is an increase to small caps, an increase to cyclicals. First of all, clients are likely underweight those areas because large cap growth has been such a great performer. Tech has been such a great performer. So it's more about bringing portfolio into balance, but it's also an argument for a reacceleration in the economy if the Fed and other central banks get it right. Now, we saw the Bank of Canada already acted. I suspect the Fed will start cutting rates sooner. And if we get that combined with continued disinflation, which improves real wages, then we could have some drivers of an economic resurgence later this year. Markets discount economic resurgences. And the way they do that typically is by small caps outperforming and cyclicals outperforming. So that's the thesis.
Among markets that you've liked, among non-U.S. markets you've liked the S&P TSX Composite, the Canadian stock market, which as we speak is trading at a record high. We've seen banks and oil companies do well so far this year.
Yes, but valuations are still relatively attractive. If we look at PE ratios relative to the All Country World Index or the MSCI World Index, the MSCI Canada, for example, looks more attractive. In addition, this Canadian stock market has greater exposure to cyclical areas of the economy, to energy, to commodities. And if my thesis comes about, if we do see that economic reacceleration, we're likely to see those areas benefit. And in fact, benefit in advance of an actual economic reacceleration because markets are discounting that reacceleration.
And you also like UK equities. Why so?
So the UK valuations are very attractive. We're also seeing an increase in buyback activity. So the buyback yield now is comparable to what we're seeing in the US, which had not historically been the case, but with a higher dividend yield. So there are a lot of fundamentals that look good for UK equities, but you always need a driver. And I would argue the driver is that the political uncertainty, if there was any, has been settled with the UK election. And so it's time to refocus on fundamentals. We could actually see some more positive consumer sentiment. And certainly once we get some cuts from the Bank of England, I think that will also be another driver that could cause a reacceleration in the UK economy. So a number of I think, compelling arguments for UK equities.